Welcome to Macro Hive Conversations with Bilal Hafiz. Macro Hive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. Greetings and welcome, Dominique. It's fantastic to have you back on the podcast show.
Thank you for having me, Bilal.
Now, you always have a non-consensus way of looking at things in markets. And perhaps I can start with asking you a question about what's your thoughts of the Trump administration during his second term?
I was expecting a lot more disruption and a lot less noise than what we are getting. Basically,
okay. So that kind of goes counter to what most people are saying, where most people seem to be saying that there's huge amounts of disruption.
Noise. Noise. I mean, to me, the key disruption was reversing the decline in the share of labor income, which is like a secular trend. And in my view, it's responsible for many, many issues facing the US. So the marginalization, economic marginalization, then anemic growth, because we have kind of a free paradox, that the propensity to spend out of profit is less than out of wages. So when we have a high and rising share of profits, there is less spending. So growth is anemic, inflation is low, central bank keep interest rates low. We have a financialization of society. The returns on financial investments become more attractive than the returns on real investment. So there isn't enough real investment, productivity is low. And I was hoping that Trump would change this, because remember, when he came in, Besant kept telling that Main Street was going to do better than Wall Street. And he actually explicitly discussed this issue of the share of wages, especially low wages in income. And to me, the ways to address this issue and increase the share of wages was to lower the relative market power of businesses and workers. And lowering the relative market power of businesses is basically competition policy. And initially, the administration started strong. They appointed a lawyer in the competition division of the Department of Justice with very strong antitrust credential. They blocked mergers. And then over the past couple of months or so, it went all by the wayside. Mergers got through that shouldn't have got through. You had some senior antitrust officials in the DOJ who got fired. Clearly, there was an internal struggle within the administration between the pro-competition camp and the pro-business camp, and the pro-business camp won. And then if you look at labor market power, so for sure, lower low-skill immigration is helping with the market power of low-skill American workers. But the problem is that it's done in such a way which is really appalling the American public and goes against the rule of law. It may not be sustainable, or it's not a consensus building policy, to put it mildly. And then you have the issue of workers' rights, things like non-compete clause, for instance, which the previous administration, the FTC under Lina Khan, she was trying to ban it US-wide. That's been given up by the administration. So I'm afraid it's back to business as usual, with a very strong stock market that basically reflects this asymmetry between the market power of businesses and workers and the concentration of the US economy and mediocre growth in the real economy. And a lot of noise around tariff, a lot of theatrics with immigration policy, for instance, but I'm afraid not seeing much progress.
And so when we look at, if we go into the details a bit more, if we look at growth so far this year, we recently received the GDP report for Q2. We've recently received a very weak payrolls report, especially with its revisions. So how would you describe, the growth we're seeing in the US so far this year compared to, say, last year?
So part of it reflects trends that pre-existed the current administration. And those trends, in my view, were aggravated by the administration. So the trends that pre-existed was a decline in immigration. There was this huge surge, which in 2024, the Biden administration belatedly realized that, oops, it wasn't great for their electoral prospects. So they started to clamp down on illegal border crossing. So that reduced both aggregate supply, the supply of labor, and aggregate demand. And in fact, if you look at the growth slowdown, it actually started in Q4. Then there is something else which I don't think has been picked up much, which was that by market analysts, which was that we had unsustainable growth in durables consumption, in part due to the consumer debt dynamics caused by enormous government transfers to household cash transfers, huge jump in nominal growth. So people felt they had room to spend more on durables, but the latest data suggests this is over. So these are the things that I think existed before inauguration, but since then we've had an enormous increase in policy uncertainties. This is a noise I'm talking about. I mean, basically, tariff policy, which under the Constitution is supposed to be a power of Congress, is completely in the hands of the executive, of the White House, and has become, not only tariffs are going up, but they are going up in a very unpredictable manner. So this has added downside to the economy because consumers and businesses are pulling in their homes. The savings rate is going up, and this is just adding to the slowdown we're going through.
And why? I mean, why hasn't the unemployment rate picked up as much as one would have thought? Given that payrolls are so weak.
We seem to have data problems at the BLS, more seriously, essentially because we've had a decrease in labor supply through lower immigration, which has been more or less in sync with a decrease in labor demand. But if you look at the data with a fine comb, not to plug my latest data NFP review, but if you really look at the details, you can really see that we're probably going to have an increase in the unemployment rate. And in fact, actually, yesterday, the San Francisco Fed president, Mary Daly, who is was, before she became president of the San Francisco Fed, and still is one of the finest labor economists in the country. She was, ringing the alarm bell on the weakening of the labor market and calling for cuts sooner than later. So it's a long-winded answer to your question. It's coming. It's just, economic time tends to be much slower than market time.
And in terms of how the Fed has been responding to this backdrop, the growth has been much weaker this year. It looks like we're averaging GDP roughly around 1% if you kind of make adjustments for the tariff related kind of noise, which is much lower than last year. Inflation has been very low, or relatively lower as well. I mean, on that basis, the Fed should have already been cutting rates. So, I mean, in the Fed's defense, what can you say?
So I would say, um, I would say the level of noise has really made it difficult to see the signal. And the Fed, I mean, the Fed main issue is not with the increase in prices. That's unavoidable. We are all going to get poorer with the tariff. Their issue is with the risk that this increase in the price level turns into a lasting increase in inflation. And that they won't know for sure until well after the administration is done raising tariff. So they have to guess, and they have to look at things like inflation contagion from tariff to non-tariff goods to services, which is not happening. They have to look at wage growth because this is a main channel through which you could have this lasting increase in inflation. And in their defense, they need a bit of data. And, the tariff increases started in earnest in April. So we've had 3 months data, 4 months data. I think, it's a matter of judgment, how much data you need to have a risk assessment that you feel confident about. So I would criticize them if they didn't ease in September, but clearly that's what they are planning to do. So, and again, in all fairness, easing now versus easing in September 6 weeks later doesn't make that much of a difference, especially since you have the option of easing 50 in September if things turn out worse than you thought. So I would say it's a matter of judgment, hard to criticize Chair Powell.
And you're looking for 2 to 3 cuts for the balance of the year, which is kind of roughly in line with what the market's expecting. The one question I did have was around US growth, which did slow down in the first half of this year if you average it for the first half. I mean, is this the new normal for US growth, 1%? Or do you think we will get a bit of a bounce in the second half?
I think we are probably not going to get much of a bounce because these consumption trends that I've just described, I think, are here to stay. The uncertainty is more about CapEx, as you highlighted. It's booming. The thing is, equipment CapEx is only about 6% of GDP, against 70% for consumption. And the flip side of this boom in CapEx is that firms seem to be cutting down on white-collar hires, so higher skill, higher wages employment. And so it's unclear how this AI boom will pan out. I would say, given the likely continuation of policy noise, high policy uncertainty, I'm not seeing much upside to growth until the end of the year.
And on the CapEx boom, can we make an analogy to the late 1990s? Of course, back then we had the dot-com boom, huge amounts of infrastructure spend, not least in fiber optics and, just internet and so on. And while there was a pickup in productivity early on in the second half of the 1990s, it didn't really continue. So the 2000s, we suddenly flipped to start to talk about jobless recovery and so on. How do you think about that versus today?
So one big difference, I think there was more euphoria in the late 1990s. So there was a higher expenditure, higher employment across the board. But the fact that the productivity growth was not sustained, in my view, goes back to this issue of the decline in the labor income share, because when you think about the impact of innovation, we are always focused on the supply side, on all those things that we are going to be able to produce at a much lower cost thanks to AI, which I believe is true. But the thing is, GDP is the sum of expenditure in the economy. Expenditure means that someone is supplying, but someone has to buy, right? So if we have a technology which is labor saving and actually lowers the market power of labor and lowers the share of labor income, we could have even more of that paradox of thrift, where the growth in aggregate demand is quite subdued. And basically, there is almost excess supply in the economy. I mean, I'm old enough to remember that in the early 2000s, Ben Bernanke was very worried about low inflation and the persistence of inflation underperformance. And I think what was driving this was, he was looking at the impact of the tech boom on supply, the overinvestment, over-hiring. So I fear that to have a lasting increase in productivity, we are going to need a more balanced growth in labor and profit share. And unfortunately, I mean, this can still change. I'm not seeing that this administration is going to bring this rebalancing.
And in terms of the impact of AI on the economy right now, where is it showing up in the data?
So you do see a huge increase in capex equipment, so equipment investment. It's probably so AI is probably one reason why NFP growth is not faster and wage growth is not higher, because AI is clearly a labor-saving technology. And by comparison with the tech bubble of the 1990s, the labor that is being saved this time around is skilled, is a higher skill, higher income. So the sort of demand negative impact, long-term impact on demand could be stronger this time around.
And if we go to the longer term, which in our case for markets would be 2026, so next year, how do you think things will play out for 2026?
So in 2026, I have a nagging suspicion that the administration, watching the dwindling of employment numbers, and just to give you a sense of where employment could settle, the CBO, so it's the agency that scores the budget, they produce comprehensive economic forecast every year. And before the pandemic, their last forecast, which was in January 2020, forecasting that due to demographics, NFP growth would slow to about 50,000 a month. So just due to supply dynamics. So my concern is the administration looking at these numbers and looking at the slowdown in growth could feel the need to put in place a stimulus of some kind, especially since, contrary to market expectations, I don't think President Trump is going to have much of an impact on monetary policy. It's unclear how many seats on the board he will be able to, how many vacancies he will be able to fill. Definitely one. It's unclear whether Chair Powell will remain on as governor, in which case that's it. It's only one vacancy. There are 12 votes on the FOMC. Even if the incoming person tries to push very deep rate cuts, I don't think it will be able to get through to the FOMC. Any event, even if it did, market would sell off hugely. So a monetary stimulus is not going to be
Just on that, I mean, obviously
yeah.
there's a lot of noise around this right now as a subject, the influence of the president on the Fed. There's a vacancy right now. But isn't next year, doesn't Powell have to step down as chair? So can't President Trump appoint somebody as the new chair of the Fed? And wouldn't they, through their seniority, be able to push through, whatever policy they wanted?
I suspect we are going towards a cultural revolution at the FOMC, where they are going to dissent with the chairman. I mean, look, in terms of, as we just discussed, monetary policy is in part judgment. It's an art, not a science. But there are, if you push things, if you push for an easing which is completely out of whack with the economic situation, people are going to react. People on the committee are going to react. And if Chair Powell decides to stay on as governor, he will be a very influential voice on the FOMC. So I think markets are paying. Again, there is a lot of noise here, but no disruption.
And just so I'm clear, the mechanism that how the FOMC makes the decision it's by a vote, is it? And it has to go by the vote.
It's by the vote. There are 12 people who vote, 7 governors, so the chair, 2 vice chair, and 4 governors of the board, plus the New York Fed president, plus on a rotating basis 4 regional Fed presidents. And President Trump is about to appoint a new governor. And that may be it, because when Chair Powell terms expires as chair, he has the option to stay on as governor. And his mandate as governor only expires in 2028. So, and I just don't think that the current FOMC would be, or the FOMC next year would be prepared to go for, rate cuts that would be completely at odds with the need of the economy.
But who picks the chair? Is it the president picks the chair?
So the president picks the chair, and by tradition, the FOMC so the president picks the chair of the board of governors. The FOMC elects its chair, and by tradition, they've picked the chair of the board as their chair, but they could very well decide to elect someone else than President Trump's choice for chair of the board of governors, so someone else as chair of the FOMC. The bottom line, I think, is that the Fed had a culture of consensus where dissents were frowned upon. I mean, there have been some former FOMC members who've written about this extensively. I think we're going towards a new tradition where individual FOMC members will feel much more liberated to vote against, the chair. In my view, it's great. That's the culture we have at Macro Hive, and I think it's the best for decision-making, for good decision-making.
Yeah, I agree. Now coming back to the budget, fiscal stimulus. I mean, how can he implement a stimulus next year? I mean, we had the big beautiful bill this year. Next year, is there a similar mechanism that he could do something else again?
So, since monetary policy will be out of his reach, there are 2 options. One is to get Congress to vote an additional package, basically to increase the deficit even more. And in fact, Republican Senator Hawley, has just presented a draft law that would give tariff payments to families. I mean, this would be loosely means tested. So a little bit of a more deficit to crank up the economic machine. Not that it will work, we can discuss in a second. The other mechanism, and thus there is quite a bit of uncertainty, but basically is tariff policy. If you look, tariff policy so far have been completely under the control of the executive. There is a lawsuit against this going through the court, which says that President Trump's use of the IEEPA is unconstitutional. The suit is working its way through the court. The lower court went with the plaintiff, but there was a stay of the judgment. The appeals court just reviewed the case. I have a nagging suspicion because even to a non-lawyer like myself, the unconstitutionality of the IEPA use is so flagrant. I have a constitution that I have a hunch that the appeals court is going to side with the plaintiff. So this will get appealed to the Supreme Court, probably not taken up until the fall. And the Supreme Court judgment typically are given in the last month of the session, which is in June. So the ruling of the lower courts will get stayed until June of next year, which means the administration will have total discretion on tariff policy until June of next year. And President Trump could very well decide to grant tariff relief just before the election. Because the thing about tariff is that they are turning out a really nice source of additional revenues for the government. All of the Congress discussions, so the OBB, 3Bs, has been done excluding tariff, with unchanged tariff policy. And this was done on purpose to give President Trump a completely free hand. So far, tariff income is running at about 50 billion more than last fiscal year. By the end of the fiscal year in September, I think could be about 120. I mean, we're going to see a tariff Laffer curve. But, I mean, there is room for generating more tariff revenues to plug the deficit. I think the administration overriding objective is going to be to generate a boom. And I suspect the easiest way for them, given that, tariffs are going to hit low-income Americans really hard, I suspect there will be a relief of some sort, cash payments or temporary lowered tariff rates. But the idea is to arrive to the midterm where typically the parties that won the White House loses ground. The idea is to arrive to the midterm with a booming economy. Now, whether this stimulus will have the intended effect is another big question mark, because we have a slowdown in the supply side of the economy caused by immigration policies. So we could well have a burst of inflation, faster wage growth rather than a real GDP growth. But looking at the way the administration is conducting policy, I would really be surprised if they saw this decrease in the growth rate and in employment without trying something to revert it. And I'm not sure that the something will be very efficient.
And you implied that the Fed may not end up cutting as much as people think then next year. I think at the moment, the consensus of economists and also market pricing is for maybe 2 or 3 cuts next year as well, on top of the cuts this year. You're much less dovish than that.
Yeah, I can see them doing at most 1 cut, because if we have stronger demand, we're going to see underlying cost pressure become obvious. I mean, look at goods prices, for instance, core goods prices. They've been increasing for the past year and a half. So a trend that started well before the tariff increases. And I think there are long-term structural reasons for that. Globalization actually weakened well before Trump won the election. If you look at the ratio of global trade to global GDP, it flattened out after the GFC, in my view, because China stopped being a low-cost place, and there were no new Chinas to be discovered. Places like Vietnam or Bangladesh, those didn't have the same combination of low wages and good business environment that China was able to offer. So global supply chain stopped bringing improvement in productivity. Then we have an issue with semiconductor productivity. The cost of chips, Moore law stopped working in the 2010s. Then I think climate change is really lifting the cost of doing stuff, construction. It's a negative supply shock. It's also a negative wealth shock. So all those things, in my view, explain why goods prices have been trending up. Then we have another issue for the Fed, which is food prices, because the food price inflation has really been picking up. And the Fed is very focused on core inflation because it's a better indicator of trend inflation. But their target is actually headline PCE. So if we have an uptrend in inflation, in food inflation, which is food is I think about 20% of a U.S. household budget, that's something the Fed will have to pay attention to. So yeah, I think the market is a little too optimistic with cuts next year, definitely.
Okay, great. Now, I didn't ask you about the debt dynamics in the US. You talked, of course, about the large fiscal bill this year, which is the increased debt. Next year, they could do something similar again. As a kind of an economist, I mean, don't you worry about debt sustainability? When I speak to investors, there's always some segment of investors who start to panic about US debt sustainability.
Oh, for sure. So for sure, the problem we have is that the sort of a crisis that we should really be worried about. We need a lot of bad luck for the crisis. What I mean is that, crises are never consensus forecast, right? Because if they were, people would anticipate them, change their behavior, and typically the crisis would not happen. So you need a trigger for the crisis to happen. Like, for instance, what about the GFC? If Lehman had not been allowed to default, so the thing is, we are definitely in a danger zone where, if you look at interest payment as a share of expenditures, you look at the relation between nominal GDP growth and interest rates, it's definitely worsening. So we should be worried, and there is every reason to reverse this crazy fiscal policy we are having. But with a little bit of luck, the US could will be able to maintain this unsustainable policy for a few more years, because it will need a trigger for the crisis. And I can think of possible triggers, like I'm wrong on the Fed, and actually President Trump manages to get the Fed to cut interest rate 200, 300 basis points. I mean, this could be a good trigger. Other things that are going on is with President Trump pushing surplus countries that have a trade surplus with the US, to lower that trade surplus. The best way, the most efficient way to do that is to increase the budget deficit and also Countries are being pushed to spend more on their military. In Europe, for instance, you have a global uncoordinated increase in deficit. That's also going to put pressure on individual countries. There will be more competition for savings. On top of that, you also have, this huge AI investment in power infrastructure. So you could have more competition for funding with the private sector. So this generalized increase in investment and in public deficit, that could end up being a trigger. So you should be worried, and you should look for things that would really unsettle market and could trigger a self-fulfilling crisis in a way.
Okay, no, that's great. Now, I think we've covered all the main bases. Now, I did want to just round off with just one or two more sort of personal questions. One, the main one, I guess, is are you engaging or interested in any sort of recent sort of cultural outputs, whether it's books or TV shows or anything?
Oh, I've been watching a really good show by David Fincher, who is really one of the top directors of his generation. It's called Mind Hunters, and it's about the FBI setting up its behavioral crime unit in the 1980s. They coined the expression serial killer. And what really makes it's a bit gruesome, I must say, but what really makes it interesting is that it shows how people were thinking about the definition of abnormality in the context of the 1980s, cultural context of the 1980s. So, for instance, you have one of the main protagonists, a very down-to-earth, senior, very experienced FBI agent who's having trouble at home and is thinking about going to see a therapist, but wouldn't this make him a bit weak? Or so very different cultural context, and it's a good perspective to have.
Yeah, that's great. Okay, well, with that, let's wrap up the call and keep up the good work as well, Dominique. Your output's always fantastic, and you always have a take that I don't have myself. So it's always good to listen to you. And what's the best way for people to follow your work?
There is only one way, and that's to go on macrohive.com. Everything I write is in there, and for our client, of course, they can always reach me through Bloomberg. And thank you, Bilal, for making Macro Hive such a good place where to work.
Great. No, appreciate that. Excellent. Thanks a lot, Dominique, and then good luck for the rest of the year.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.